Saving on taxes is all about control. Well, in this video today, I'm going to show you how you can save thousands on capital gain taxes by gaining more control over your situation. Now, this simple trick is available to every investor and couldn't be easier to implement. So let me show you what I mean. So very simplistically, when we have a capital gain, we have a situation that looks somewhat like this. We have our cost basis. Your cost basis is what you purchase that given investment for. Then when you're selling that given investment, you're selling based on the current market value. Well, if that current market value is higher than your cost basis, you have a capital gain. If it's lower, you then would have a capital loss. Now, many investors can affect how much they pay in capital gain taxes from year to year based on what they report for that given cost basis. And many investors don't know that you can actually affect this cost basis reporting. So in the eyes of the IRS, it is you, the taxpayer, that is completely responsible for keeping track of your cost basis through time. And once you sell any given investment, reporting accurately that cost basis to the IRS. Now, keeping track of your cost basis information seems like a tall task for many of us. Oftentimes, we are purchasing multiple lots through time as we're dollar cost averaging with our contributions, or if we have a dividend reinvestment program. Well, luckily, custodians are required by law to keep track of that cost basis reporting on your behalf. Now, on the right-hand side of the screen, you'll see a common example that an investor would have for a specific investment. You'll see they have different tax lots here that each have a different holding period, have different quantities worth of shares, as well as different gains versus losses based on the investment path after that purchase date. Now, a big mistake that I see a lot of investors make when they're selling investments from their taxable account is they use the default cost basis reporting method. For most custodians, this is FIFO, which means first in, first out. This means that when you sell shares of any individual investment, you are first going to sell shares that were first acquired. These are shares that typically have the largest capital gains because they've been held for the longest amount of time. Now, this often leads most investors to leak capital gain taxes from their taxable account because they lose control over selling specific tax lots. For instance, let's say that somebody wanted to do some tax loss harvesting. Out of all of the tax lots available, we would want to sell that fourth tax lot that's currently at a long-term loss. If this investor went in and sold 28 shares thinking they'd be selling that capital loss, they would be quite surprised when they actually found out they sold 28 shares of that first lot and now had a long-term capital gain because of it.
You can't be serious, man. You cannot be serious!
Now, despite this being the default for most custodians, you do not want to use this cost basis reporting method. The second most common cost basis reporting method is something called the average cost method. Now, as this method sounds, you take the total purchase amount for all of these shares that you currently hold, and then you would divide that by the number of shares you hold to find the average cost. Now, for each share of an investment that you sell, you're going to be taking the market value of that share and then subtracting out the average cost basis. Once again, you do not want to use this cost basis reporting method. There would be no opportunity to do tax loss harvesting here because every share that this person sold would be at an average capital gain. And so there are a number of methods that you can ultimately use. Everything from first in, first out. Last in, last out, the opposite of first in, first out. You could use the high cost method, meaning that you're selling investments that have a high cost basis. You could use the low cost method, the average cost method, loss gain utilization, or what every investor should be using, which is specific lot identification. And the reason you want to use this is because you gain complete control over which tax lots you ultimately sell. Let's go through a few examples to show why this specific lot method is so powerful. So in this first example, we have investor John here that is currently in the 0% long-term capital gains bracket. Now, we know that when we're in a 0% bracket, we almost never want to leave that bracket unfilled because we can update that cost basis at a zero tax cost. And so investor John has $12,300 left in the 0% long-term capital gain bracket. So as John is looking at his investments, he's going to look at what specific tax lots best fill in the 0% bracket and thus sell those specific tax lots. So in his situation, he'd want to sell a combination of the first three tax lots that he sees within his account. If he sold the last tax lot, he would be selling that at a short-term capital gain, and thus there is no 0% bracket. Another example would be if somebody wanted to do some tax loss harvesting as we described before. So investor Cindy is showing no capital gains for the year, and is currently working and is in the 32% income bracket because of her working income. And so through her given tax lots, we see that she has one long-term capital loss here. This would be the only investment that she ultimately wants to sell, because if she sells any other investments at a gain, they'll start eating into that loss. Now, if she sells this given investment, she can take that loss against her income, thus lowering her income and saving in that 32% bracket. And so Cindy would want to identify this 28 quantity tax lot here at a $1,614 long-term loss and offset her income, thus lowering that tax bill because of that offsetting. And the reason control is so important is because at different points in your financial life, there will be different strategies that you may want to implement. There may be other times in retirement where you want to nail a specific income target. Let's say this is for Medicare's IRMA, or let's say prior to 65, you're trying to hit a specific target for ACA insurance. Well, you may want to go in and take specific tax lots that might have a low capital gain, because you want to nail that target. You want to create income without having a huge tax liability for doing so. Now, unfortunately, most custodians by default use the wrong cost basis reporting method. The good news, however, is you can change this cost basis reporting method with very little negative repercussions. If you're using the first in, first out, last in, last out, high or low cost methods, you can generally change these without any negative repercussions to that specific lot identification method. However, if you're using the average cost method and you've already sold some shares of that given investment, unfortunately, you can typically not change that cost basis reporting method moving forward. It's also important to note here that many custodians use a different reporting method, whether these are stocks or ETFs, or whether these are mutual funds. Most stocks and ETFs will be set as a first in, first out reporting method. Most mutual funds by default will be set as that average cost reporting method. Now, this simple trick to change your cost basis reporting method is one of the simplest ways that you can start to save on capital gain taxes. Now, you can affect your capital gains tax bill in greater ways if you're willing to dive a little bit more into some additional complexities. For instance, in this video right here, we talk about another strategy called yield splitting. This strategy can give you further control over your situation and allow you to layer on additional strategies from year to year to save on capital gain taxes. Click on this video right here to learn more, and always remember, you don't need more money, you need a better plan.